let's talk more about the big picture context here for the moves in the bond market and the ripple effect throughout markets. Lisa Erickson joining us now, U.S. Bank head of the Public Markets Group. Lisa, thank you so much for being here. It's good to see you. I know we're not at 5% right now, but obviously we touched 5%. What does a 5% 10-year yield mean for U.S. equities?
Well, certainly 5% is a psychologically important number because it really represents another level to which the rates have moved, not only, of course, on the short end because of Fed hikes, but also as being reflected by market participants in some of the longer sectors that, to your point, can really impact some of the other borrowing costs throughout the economy. And so I think what we're really just seeing with the last few market moves in the stock area, that really investors are just becoming more aware and cognizant of that higher for longer mantra, not just with what's going on with the Fed, but again, how market is pricing that out on the long end.
And Lisa, I'm interested to get your take on what you made of Fed Chief Jay Powell's comments yesterday. Did you find them hawkish or dovish? I mean, he seemed to have a bit of something for everyone there.
Well put, Josh. We really saw it as both sides of the coin. He certainly recognized the fact that because longer term interest rates are also moving up, that could be a consideration in terms of where the Fed moves its policy and potentially give them a little reason to be a little bit more cautious in further hikes. But on the same time, he made it very clear that the job is not done, that he doesn't see policy yet as too tight. And so, again, leaving open that door for further hikes. So that, I think, is, again, part of what has the market on edge, because you certainly are hoping, or the market has been hoping for some relief in terms of pausing, but it's just not clear yet when that's going to happen.
And so what are then the implications for people's trading strategy right now? Are you recommending that clients get defensive in this environment when it comes to their equity allocation?
We're right now at a neutral posture on the equity market. And while there are risks, like we have been talking about, the fact that rates have been moving upward really for the most part, even though, again, some back down today, as well as, continued tightness in monetary policy and economic growth generally slowing. On the other hand, we have still a very resilient consumer. And you see that in Red Book sales, you see it in the retail sales number. We had it earlier week, and you certainly see it supported by the jobs market. And so really, you've got this balance of puts and takes right now. And so we really feel for clients to be neutral to whatever is typically their long-term allocation to equities makes sense.
And Lisa, in equities, as much as you're neutral on the market, do you see opportunities in more maybe defensive sectors? Is it utilities or staples?
Well, certainly, as we look at year-to-date performance, one of the areas that really has lagged, even relative to some of the declines we've seen recently, is the defensive sectors and some of those more income-oriented sectors like utilities, like consumer staples, and with the nice income and cash flow they can offer over time, and at now even more compelling valuations, we do think they may be of interest for clients with time horizons further out than a half a year.
Further out than a half a year, because I think of some of these groups as well when we talk about defensive sectors as those that don't necessarily perform well when interest rates are high, right? When you talk about real estate or utility. So is that why you sort of have that longer time horizon caveat?
Absolutely, because in the near term, to the extent we've still got this upward rate momentum, they could continue to see some valuation compression. But again, for those who can look past that and hold for a little bit longer term time horizon to take advantage of eventually, hopefully, sentiment shifting, as well as, again, those ongoing income streams from dividends, that should be helpful.
And Lisa, in general, I'm curious what you're hearing from clients right now, right? It's sort of an unusual moment. There's a lot going on in the geopolitical stage that is making people feel worried, right, from an emotional perspective, even if it's not necessarily having a direct effect on the markets. You know, earnings so far have been coming in pretty well, right? As you said, the consumer spending is holding up pretty well. Give us a vibe check, for lack of a better term, on what you're hearing.
Well, certainly uncertainty is the word of the day, not really only in markets with this volatility that we've been seeing, but across all of the market participants. And I think it really is coming from the combination of the fact that we're at an unusual economic inflection point. We certainly have never had in recent history, such dramatic events as almost total shutdown from the pandemic, then, sort of the rebound as people were able to release, and on top of that, quite a bit of monetary and fiscal stimulus. So exactly how this plays out, how quickly the remainder of the path to inflation makes it down to that 2% target is all unclear. And to your point, we now have some extra forces on energy and some conflicts worldwide that, again, just raise the level of uncertainty. So again, that is helping us to contribute to our neutral positioning right now on the stock market. But again, I think just watching how these events unfold because of that higher level of potential volatility and uncertainty is really a word of the day.
Lisa Erickson, thank you so much for joining us, Lisa.
Thank you for having me.